To really understand how liquidity risk management has become what it is today, we need to take a step back and look at where it all began. In this session, we'll explore the history of banking liquidity through the lens of past financial crises and pivotal moments. We'll see how every major banking failure has left a permanent mark on regulation, supervision, and how banks approach liquidity. By tracing this evolution from the bank runs of the 19th century to the modern-day collapses of Silicon Valley Bank and Credit Suisse, we'll reveal how each chapter in financial history has pushed liquidity higher up the agenda for banks and regulators alike. So let's start with the earliest instances of liquidity failure, the classic bank run. In the 19th century, banks operated in a fragile financial environment with few protections and limited oversight. Depositors would queue outside banks at the first sign of trouble, driven by fear that their money might not be there tomorrow. Now, these runs were often self-fulfilling. Even if a bank was financially sound, the mere act of people withdrawing their funds in their masses could cause it to collapse. Now, one of the earliest recorded examples was the 1866 panic in London, where the collapse of Overend, Gurney and Company, a major wholesale discount house, caused panic across the British banking sector. Depositors rushed to withdraw their savings from numerous banks, many of which were unable to meet the demand for cash. Now, that panic set a crucial precedent. It forced the Bank of England to step in and act as what we now call a lender of last resort, a concept formalised by Walter Bagehot, a 19th century economist whose thinking still underpins central bank doctrine. Bagehot's guidance was simple but powerful. In times of panic, central banks should lend freely to solvent institutions against good collateral and at a penalty rate. This wasn't about rescuing failing banks. It was about stopping panic from spreading to healthy ones. His principle has shaped central bank responses to liquidity crisis ever since. Now, moving to the United States, the early 20th century saw repeated and devastating bank runs. Without a central bank at the time, i.e. before the Federal Reserve was created in 1913, banks relied on informal arrangements and private networks to try to stem crisis. The Panic of 1907 is particularly notable. It started with the collapse of a speculative scheme to corner the copper market and escalated rapidly, spreading fear throughout New York's financial system. Several banks and trust companies experienced runs. Confidence collapsed. And with no central bank in place, it was left to private bankers, most famously JP Morgan, to orchestrate a bailout. Now, Morgan gathered leading bankers in his library and effectively locked them in until they agreed on a rescue package to inject liquidity into the system. Now, while the panic was eventually contained, it exposed how vulnerable the system was without a central mechanism to provide emergency liquidity. It also sparked the political momentum to create the Federal Reserve, which was established just 6 years later. Now, the Fed's creation marked a turning point in how liquidity was managed. With a central authority in place, banks now had a backstop, someone to turn to if market funding dried up. But this wasn't the end of liquidity-driven crisis. Just 2 decades later, the Great Depression delivered another blow. In the early 1930s, over 9,000 banks in the US failed, many due to classic liquidity runs. Even though some of those banks may have been solvent, they couldn't meet mass withdrawal requests. Now, what made this different was the scale. Unlike previous episodes, this wasn't just a handful of institutions. It was systemic. People had lost faith in the banking system altogether. To stop the hemorrhaging, the US government introduced a landmark reform: deposit insurance. When the Federal Deposit Insurance Corporation, or FDIC for short, was created in 1933, it guaranteed that depositors would be repaid up to a certain amount, even if their bank failed. Now, this dramatically reduced the likelihood of retail bank runs. If depositors knew their money was safe, they had little reason to panic. The UK and other countries followed with similar schemes in the decades that followed. Now, from a liquidity perspective, this was a game changer. Deposit insurance became the first major structural defence against liquidity runs. And for the next several decades, the global banking system enjoyed a period of relative calm. Banks operated within tightly regulated environments, often with restrictions on interest rates, capital flows, and the types of business they could engage in. The focus was on stability rather than innovation, and liquidity management during this time was relatively straightforward. Banks kept higher levels of reserves, often as a regulatory requirement, and funding markets were more predictable. But this stability wouldn't last. In the 1970s and 1980s, inflation, deregulation, and globalization began reshaping the financial world. Banks increasingly turned to wholesale funding markets, raising money not just from depositors, but from other banks, investment funds, and global money markets. Now, this shift created a new form of liquidity risk. Wholesale lenders were far more sensitive to market sentiment than retail depositors. If they sensed any weakness, they could pull funding overnight. And they did. One of the earliest warnings came in 1984 with the failure of Continental Illinois, then the seventh largest bank in the US. Now, although its underlying problem was credit-related, bad loans to energy firms, the real killer was liquidity. Once investors and counterparties lost confidence, the bank faced a rapid withdrawal of wholesale funding. Now, in a matter of days, it was effectively shut out of the market. The government had to step in with a $4.5 billion bailout, the largest of its kind at that time. Now, it was during this crisis that the term too big to fail entered the mainstream. And the lesson was clear. A liquidity crisis can bring down even a large, well-capitalized institution if confidence evaporates. Now, despite this warning, liquidity risk remained something of a secondary concern through the 90s and early 2000s. Regulators were primarily focused on credit and market risk, and the Basel I and Basel II frameworks reflected that. Now, these accords focused on capital, i.e. how much a bank needs to absorb losses, but said very little about liquidity. Now, banks were left to manage liquidity according to their own policies, guided by broad principles, but without detailed global rules. Many developed their own internal models and risk appetites, but practices varied widely across institutions and countries. Now, this gap became painfully obvious in 2007. The global financial crisis, which began in the US subprime mortgage market, quickly spiraled into a full-blown liquidity meltdown. Banks and investors realized that assets they thought were safe and liquid, like mortgage-backed securities, were anything but. Confidence vanished almost overnight. Funding markets froze. Even banks with strong capital positions couldn't refinance their short-term obligations. Northern Rock in the UK became one of the first casualties. It had relied heavily on wholesale markets to fund long-term mortgage lending. Now, when those markets dried up, it had no fallback. The images of customers queuing outside Northern Rock branches marked the first bank run on a UK institution in over a century. From there, the crisis escalated. In the US, Bear Stearns collapsed in early 2008, rescued only by a government-brokered sale. Lehman Brothers wasn't so lucky. When it filed for bankruptcy in September of that year, the shockwaves rippled through the entire global financial system. Suddenly, no one wanted to lend to anyone. Interbank markets froze, asset prices collapsed. Even institutions that had done nothing wrong found themselves unable to fund their operations. The fear was universal. What if I lend to you today and tomorrow you're gone? Now, what made this crisis different was its speed and scale. It exposed how interconnected the system had become and how little resilience there was in terms of liquidity. Banks were over-reliant on short-term wholesale funding. They held too few truly liquid assets. Their contingency plans didn't account for markets shutting down completely. And worst of all, they underestimated how quickly confidence could vanish. Now, in the aftermath, regulators acted decisively. The Basel Committee introduced Basel III, a sweeping set of reforms designed to strengthen bank resilience. And for the first time, liquidity was given equal footing with capital. Two new global standards were introduced: the Liquidity Coverage Ratio, or LCR for short, and the Net Stable Funding Ratio, NSFR for short. The LCR required banks to hold enough high-quality liquid assets to survive a 30-day market-wide stress event. The NSFR ensured banks had stable funding for their long-term activities. Now, these rules changed the game. Liquidity was no longer just an internal risk to be managed. It became a regulated obligation. In Europe, regulators introduced even more stringent measures. The European Banking Authority and the European Central Bank implemented detailed frameworks, including the Internal Liquidity Adequacy Assessment Process, or ILAP for short. Banks were now required not just to hold buffers, but to explain and justify how they managed liquidity risk. This included documenting their risk appetite, describing their contingency funding plans, and proving that senior management understood the risks and approved the strategies. In the UK, the Prudential Regulation Authority followed a similar path, incorporating liquidity into the wider Supervisory Review and Evaluation Process, or SREP for short. For the next decade, these reforms reshaped banking. Liquidity risk management became more sophisticated. Banks invested in better data, analytics, and governance. Treasury functions became more centralised and more powerful. Stress testing evolved, becoming a core tool not just for regulators, but for internal planning. Liquidity buffers increased significantly, and the lessons of 2008 remained fresh in everyone's mind until the next big test arrived. And that test came in 2020 with the outbreak of the COVID-19 pandemic. Financial markets faced an unprecedented shock. As economies locked down, markets panicked. Corporates rushed to draw down credit lines. Investors fled to cash. Some markets, including even parts of the US Treasury market, became dysfunctional. Once again, liquidity was under pressure. But this time, the outcome was different. Banks held more high-quality liquid assets than ever before. Central banks acted swiftly, injecting vast amounts of liquidity through emergency lending programs and asset purchases. Regulators temporarily relaxed liquidity rules, allowing banks to dip into their buffers. And despite the turmoil, most banks stayed afloat. The response to COVID-19 was a validation of the post-2008 reforms. Banks were better prepared. Liquidity plans were more robust. Stress scenarios had accounted for sudden demand spikes. And importantly, the coordination between banks, regulators, and central banks was stronger. Liquidity risk had finally become something that the industry truly understood and respected. But history doesn't stop. In 2023, new reminders emerged. Silicon Valley Bank collapsed after rapid withdrawals by tech clients triggered by fears over interest rate risk and an asset liability mismatch. Its funding model, relying on a concentrated, sophisticated depositor base, proved fatally fragile. Credit Suisse followed shortly after, as confidence in its future evaporated amid a string of reputational hits and risk management missteps. Though different in their specifics, both cases underscored an old truth. Liquidity crises happen fast, and once confidence goes, it's almost impossible to get it back. So what does all of this history teach us? Well, first, that liquidity risk is nothing new. It's been a threat to banks for over 150 years. Second, that each crisis brings new lessons. Whether it's the need for central banks, the value of deposit insurance, or the importance of high-quality liquid assets, each reform has built on past failures. And third, that complacency is dangerous. Just because liquidity risk has been quiet for a while doesn't mean it has disappeared. In fact, it's often when things seem calm that the seeds of the next crisis are sown. For today's financial professionals, understanding this history isn't just academic, it's practical. It explains why regulations are the way they are. It clarifies why certain buffers exist, why stress testing is essential, and why risk managers always ask, what if? And most of all, it reinforces the idea that managing liquidity is about preparing for the unexpected. The past shows us that the unexpected happens more often than we'd like to admit. In our next session, we're going to build on this historical foundation by diving into the different types of liquidity risk that banks face today. We'll break down the distinction between funding liquidity risk and market liquidity risk, explore contingent liquidity exposures, and introduce some of the key indicators banks use to monitor risk in real time. By the end of the next session, you'll have a clear framework for identifying the various ways in which liquidity risk can manifest and how banks keep it under control. I'll see you in the next session.